Hey everyone, Jeff Dorman, CIO of Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the digital asset market space like we've been doing every week for the last 7 years. For those who are more visual learners or prefer to read, you can go to our website, ar.ca/blog, and read full blogs about what we're talking about. Sometimes we talk about what we write about, sometimes we talk about other things. But today I am joined by Michal Benedict, who has been on our venture investing team for the last several years here at Arca. Michal, how are you?
Very well. Thanks for having me.
Yeah, thanks for being here. And we're going to talk mostly about the Digital Asset Summit that he attended last week and some trends and themes that we're hearing for the remainder of this year and beyond. But before I get into that, as always, this is not investment advice. As I did mention, there is a blog as well. I actually wrote a ton this week about token buybacks and why there's a lot of changes right now in the digital asset market. A lot of people starting to realize that fat protocol thesis is nonsense, and layer ones at these absurd valuations are nonsense, and meme coins are nonsense. And we're getting back to roots, which is, things have to have value to be valuable. And how do you make something valuable? You create cash flows, revenues, and profits. And how do you actually support a token price? You do buybacks. There's been a lot of interesting rhetoric recently that buybacks are not good use of capital for a variety of reasons. One, because it's not actually working in terms of supporting prices, and two, because it's just not the best use of capital for a young team who should be reinvesting in their business. We debunk almost all of that. Like I said, check out the blog, go to our website, ar.ca, read what we wrote about this. But essentially, this is nonsense. Buybacks are great. Every company and project that has any sort of revenues and cash flow should be doing buybacks. I compare buybacks of tokens to buybacks of equities, and why we really like things like Hyperliquid and Radium and Jupiter and Aave and others, Maker, that are starting to do buybacks, in the market. So check it out when you can. I'm not going to talk about it today on this show, but we are going to talk about what you saw last week from the Digital Asset Summit in New York. Michal, shout out to the Blockworks team, I believe, who put this on. I didn't go. I'm not sure I've ever been, actually. That's not true. I think I've been once or twice. But what did you learn? What was happening last week? Is there any reason to actually care about crypto anymore? What's happening?
Yeah, absolutely. And I think for those that have been following reporting on crypto Twitter and the overall sentiment around the conference, many of the attendees, myself included, came away feeling that it's almost a kind of a tale of two cities. You have the institutional crowd extremely fired up, really building real products, bringing assets on chain, talking shop, and this time, rather than doing what they have done in cycles prior, being a lot of the innovation theater, there are real products that are now actually on chain. Some already generating healthy yields. Others will soon to kind of be available to broader market. And so you had that very active camp of the institutions that were in attendance, that were there and really meant business. Meanwhile, there is also the other side of our industry, which has been a lot of the retail investors in crypto Twitter that kind of latched on to this doom and gloom vision of where we are headed. So it was truly refreshing to go and meet in person with some of the actual decision makers as a part of these institutions. And again, kudos to Jason and Matt at Blockworks. This was pound for pound one of the best institutional events, just from a sheer concentration of the decision makers that were there in the room. Not only they've smashed kind of the record attendance with over 2,500 attendees, but more importantly, I think to our conversations and discussions behind closed doors, you had real executives at very real TradFi firms that were bringing these assets on chain and sharing the journeys that they were on for the better part of the last few years to make it happen. So that really kind of stood out for me as extremely insightful, and I'm happy to kind of delve a little bit more in detail as well.
Is that why you cited a tale of two cities? Because it's the best of time for people who are not in crypto yet on their way in, and it's the worst of times for those who have been suffering through the price action?
100%. 100%. And there was extremely meetings that I was going and really weaving between some of the crypto natives and the institutions. it really truly felt people were kind of in their little respective echo chambers. So ultimately, I think what came out of this conference is that we are headed for some form of convergence between the two worlds, spearheaded by much better regulatory climate, probably the best regulatory climate actually that we could have ever hoped for, our asset class. And then real action and activity for the institutions kind of coming in and issuing on chain. I think supply side, as I've mentioned in our notes, have not been an issue. So essentially supply of real assets wanting to kind of come on chain. The technology is also no longer an issue. Some teams already have very robust teams in-house and can do these issuances by themselves. Others rely on great third-party partners like Securitize to help them shepherd them along the way.
Let's separate that out for a second. So let's separate out what are like the larger TradFi asset managers and brokerages doing, and then separately, let's talk about the actual crypto exchanges and fintech guys and things like that. So let's start with this first part. The TradFi asset managers, the brokerages, like what are they most excited about? What are they looking at? What are the common themes?
For sure. And I would say probably one of the lowest hanging fruit, the most commonly quoted tokenization efforts. One had to do with credit. I think if you look at the rwa.xyz, and we're happy to kind of link it, there is a prevalence of vast majority of RWAs on chain today being ultimately credit facilities. Mm-hmm. So that is a lot of where the currently appetite resides and also where the issuers are focusing on. So someone like a large asset manager that has a diversified credit portfolio, they will look to ultimately take a sleeve of that portfolio, tokenize it to bring it on chain and introduce ultimately a non-correlated source of yield to some of these on-chain products. And I think this has been probably one of the more popular use cases that we talked about.
Yeah, but let's be honest. I mean, like everyone's talking about the growth of RWAs. Thus far, the growth of RWAs has just been U.S. Treasury bonds on chain, and even when we say private credit, it's dominated by the HELOCs from Figure. I mean, there's not a lot actually happening on chain right now, other than what Figure is doing with home equity loans and what BlackRock is doing with treasuries. Is there more that I'm missing?
That's correct for what is on chain today. I think what I was alluding to is some of the facilities that are going through the workup and will be coming to the market this year. And so those have been in the vein of some of the funds, a lot of funds that are trying to kind of tokenize their offerings, whether they're credit funds, whether they're infrastructure funds from Hamilton Lane, or credit funds from Apollo were some of the examples that I had in mind and counterparties that we've spoken to in New York last week. So what they're doing right now is ultimately playing the field. And what I mean by that is they're going to each and individual layer 1 or layer 2 and ultimately testing and trying to see, is this like the best home for my assets? Is there actual demand for my assets? And more importantly, will bringing that real world yield on chain will kind of move the needle or perhaps kind of discover a new source of appetite for those assets. This is ultimately still very much, like you said, Jeff, the numbers today dominated by a lot of kind of the treasuries as well as the HELOCs from Figure. But the kind of next wave of assets that are going to get tokenized or are launching soon are kind of in the alternative credit and fund structures that are trying to kind of open up new.
And look, there's only really two reasons to do this, right? One is because you think you're actually going to find a new buyer base that doesn't exist elsewhere. I'm not sure I really believe that yet, because the reality is there's 99% more buyers in the real world outside of crypto than there are in crypto. So I'm not really sure you're opening up a new buyer base by doing that. Secondly, would be to utilize DeFi, right? Because right now, most private credit is a pretty unproductive asset. You can't really use it in terms of collateral with prime brokers. It's sort of just, this off balance sheet item. If you can put this stuff on chain, and then all of a sudden you can make this a productive asset by using it as collateral for loans and other things, then all of a sudden, maybe you're not introducing a new buyer base, but you're enticing the existing buyer base to get bigger because it's no longer just dead capital. So I think really the beneficiary here is DeFi, which actually leads me to the next point, which is, well, what's happening with the exchanges then? And I'll take Coinbase for an example, because I think Coinbase is just a colossal failure in my opinion in terms of what they could have done versus what they have done. Meaning, all they've done is just bad acquisitions, support the venture market, nothing to actually make the secondary market better. And now they're in a really big problem right now, which is that decentralized exchanges are eating centralized exchanges' lunches in terms of the total number of volumes and revenues and new issues that are now flowing through decentralized exchanges. Meanwhile, the real centralized exchanges, the real centralized brokers, because let's face it, Coinbase is more of a broker than it is an exchange. Your Robinhoods, your Fidelities, your JP Morgans, Goldmans, like they're coming for you. So how does somebody like a Coinbase or a Kraken, especially knowing that Kraken is trying to IPO for the 5th time, how does Coinbase and Kraken and even Binance to some extent compete when you get the big guys coming from TradFi who are going to dominate them from a fee standpoint and from a customer standpoint, combined with the decentralized exchange usage, which is much more useful, cheaper, and beneficiaries of this RWA move?
They're 100% playing catch up. And so unsurprisingly, the last day of conference, Kraken made the announcement about acquisition of NinjaTrader. Really the US-based exchanges in particular, but also, as you mentioned, some of the offshore exchanges that are trying to come, or in some cases re-enter US, are all looking to offer equities. I think it's going to be table stakes in not too distant future. But I would tend to agree that in terms of their competency today and some of the gaps that are yet to fill, to be able to pound for pound compete with the likes of Robinhood and your Schwab and Fidelities, it's a very steep hill to climb. And especially if you're looking at some of the leaders inside, specifically Robinhood, not to single them out, but have been extremely progressive. And this also came across in our conversation last week in New York about expanding and really truly understanding the scope of the opportunity by expanding their existing crypto offering outside of kind of like the, let's call it, top 20 tokens to a much broader universe, really to rival some of the already existing centralized exchanges like, say, Gemini's. But on top of that, bring an incredibly loyal cohort of the customers that are, mind you, growing up and have been growing up with their user base.
But their customers hate them. I mean, have you ever seen the response? I mean, the customers hate these centralized exchanges. They're slow with withdrawals. They have no customer support. Like, you compare that with Merrill Lynch, where you can get somebody on the phone in 4 seconds. Mm-hmm. It's just, again, to me, it's just a complete miscalculation in terms of what they've spent their money and their time focused on. Now, again, I'm picking on Coinbase a lot because I think they're the worst of this. But Coinbase has done some good things in the sense that obviously the legal team of Coinbase has fought a great fight for the industry. But the actual product and business executives at Coinbase, I mean, it's just been failed project after failed project. And ultimately, they still can't get out of their own way with the fact that it's a high fee business in a commodity offering. And, I think to your point, like, it's going to be a lot easier for these equity brokerages and these fixed income brokerages to introduce crypto to their, billions of customers than it's going to be for Coinbase to get their small cohort of people who are only on Coinbase trading stocks when most of Coinbase's customers already have a Robinhood or a Schwab or whatever account, right? So it'll be interesting to see. I mean, I am probably as negative as I've ever been on Coinbase and Kraken, simply because, again, I just think they've just fumbled the lead so badly here, and all the data is pointing to these guys being irrelevant in 5 years. But it'll be interesting to see how they try to reinvent themselves here and what they ultimately focus on.
100%, and each of them also are pushing new initiatives of kind of migrating that big, large user base on chain, and maybe offer more products that way as well. That's Base in case of Coinbase, and then Inc, which is the layer 2 pushed by Kraken. But yep. I agree. I think really challenging environment for decentralized exchanges next few years.
Okay, so we talked about RWAs. talked a little bit about DeFi. I assume stablecoins, the other big thing that everyone's talking about in terms
Bingo.
of
Yeah, that
Washington
has
policy.
been absolutely talk of the town. Whether you are talking with the existing investor crowd, what they're looking for, everyone is racing to find and position in stablecoin and stablecoin adjacent businesses. But I think primarily refreshing perspective have been from some of the regulators that were in town last week for DAS, that is both from the Democratic as well as Republican aisle, talking about the Genius Act and Stablecoin Act here. Probably the most optimistic view that I've come across is that we should have that regulation on President's desk by August, even within the next 60 days. And so many of the players are positioning accordingly. And that is either racing to build up these competencies internally or just outright acquire where there might be missing that competency. So certainly from my conversations, whether it was with Republican Tom Emmer or Democrat Wiley Nickel, it came across that really the ultimately goal that is good for digital assets is to find a way for both parties to work on it as a bipartisan effort, especially as we're headed into midterm elections 18 months out, which could present a potential challenge if there isn't essentially a quorum for the vote supporting this initiative on both sides of the aisle. So everyone very focused, very clued in, and suffice to say, we also had the sitting president address the Digital Asset Summit, something I forgot to mention, but certainly industry first and fantastic get for Blockworks. And in his address to the audience, he very much reiterated all the promises made, promises kept, and highlighting especially the stablecoins, how vital it is for USD to kind of retain the status as a dominant reserve currency, the stablecoins being very much kind of part of that mission.
Yeah, it makes sense. I think, it certainly, that's consistent with what we're seeing and hearing every day as well, is that, DeFi is really interesting to people. RWAs is really interesting and bringing things on chain, and certainly stablecoins. So as you said, the real question, as you said, we're going to hear a lot in the next couple of months with regard to Washington policy as it pertains to stablecoins. What will be interesting to see is how, if at all, this impacts the rest of the market. I think, one of the things we've been doing now for 7 years since starting Arca was identifying themes and areas that are really going to be impacted by blockchain. And some of them we've made a lot of money on, obviously, as investors, things like DeFi, even to some extent gaming and NFTs. Some have been impossible to really make any money on, like stablecoins, right? The only people making money on stablecoins are the stablecoin issuers themselves. And obviously Tether and Circle, being private companies, has been harder to benefit from. And then you're just, taking a stab at the makers and the Athenas and even the Terra Lunas, which obviously have had incredibly mixed success, if any, from an investing standpoint. So it's definitely been challenging for investors to find a way to make money from the growth of stablecoins. But on the flip side, if stablecoins really do get to $1 trillion or $2 trillion, it ultimately just brings more and more money on chain, and that has to flow somewhere. So it should be a net positive for the market. Okay, let's leave it on this, Michal, as we bump it up on time here. One of the things we heard from all you and everyone else at ETH Denver was kind of a funeral out there. Everybody was miserable because those are all more, crypto native folks. Sounds like opposite vibe, what you got at Digital Asset Summit. A lot of outsiders coming in with, fresh eyes and bushy tails, excited about the future of crypto.
Indeed. Yeah, I think it's a great way to finish there. And definitely a big running debate on what the stable coins will bring and growth of the stable coins will bring to overall market. But for that, I would send everyone to two sets. I think the discussion around cash flow generating protocols and fees is very timely, and certainly something that we are only just starting to hear more about.
Yeah, I think it's again, I think this has been criminal, honestly, on behalf of some of the bigger players in crypto, that they've focused so much attention on Bitcoin and Solana and Ethereum, and so little on DeFi and other cash flow producing assets. Because let's face it, 99% of investors don't care about Bitcoin or gold. They care about stocks and bonds, and those are cash flow instruments. So we should be focusing more energy as a industry on the hyperliquids and the radiums and the Jupiters and the Aves and the Leos and the BNBs and the tokens that actually can be valued using traditional financial analysis, because that's what most investors care about. So, the greatest trick crypto ever pulled was getting people to believe that Bitcoin was somehow safer than a cash flow producing asset with buybacks. But here we are. So as we get this new wave of investors and partners and players in this space focus on RWAs and DeFi and stablecoins, I do think we will see a return to value investing as well. I mean, that's sort of the natural next state. So we'll see what happens as we go on further from here. Michal, I appreciate you giving us the recap of the event last week. Again, shout out to Blockworks and the team there putting on a great event, it sounds like. And Michal, thank you as always for joining. We will talk to you soon, sir.
Thank you, Jeff. Bye, everyone.